Okay, when the business sell goods on credit, we'll need to record 4 accounts. Okay, because the keyword is on credit. Okay, so the first account that we record will be trade receivables. So we debit trade receivables. Okay, and we credit sales revenue. Okay, this is the amount that the business earns. And we also have to record the cost of sales. So we debit cost of sales. Okay, and we credit inventory because the inventory is sold away. Okay, so this will be the debit credit. Okay, and when the goods are returned, we'll just reverse out everything that we have done just now. So the first one, we will debit my sales returns. Okay, because the goods are returned from the customer to the business. Okay, and now, okay, the customer owes lesser to the business, so I credit trade receivable. Okay, and I reverse out the original entry, so I debit inventory because the goods are now returned to the business, so my inventory goes up. Okay, credit costs of sales. Okay, third step, debtors pay the business by check or cash. Okay, the word debtor actually means, okay, credit, customer, which also implies this is my trade receivable. So in this case, the trade receivable actually goes down. So I credit trade receivable. Okay, and I debit either cash in hand or cash at bank because the business receives the cash or check from the customer. Okay, last one. The check given to the business is dishonored. So in this case, okay, we will reverse whatever that we have recorded just now. Okay, in essence, the business did not receive any cash from the customer because the check is dishonored. So we have to reverse it out. The cash at bank actually goes down because the business did not receive anything from my customer. And because the check is dishonored, customer actually owes the business more money, so my trade receivables go up. If it helps, okay, you can actually write down here, trade receivables go up, cash at bank goes down. Okay, whereas for number 3, my cash in hand or cash at bank goes up, trade receivables goes down because they owe less. Now let's move on to the next slide. So when preparing the trade receivables account, we always ask ourselves, okay, will this transaction cause the customer to owe the business more or owe the business less? If the customer actually owes the business more, we debit. Customer owes the business less, we credit. Okay, because trade receivables, okay, in summary, right, is actually the amount customer owes to the business. Okay, and we also know that trade receivables is a asset. Okay, and an asset has a debit nature. So when customer owes more, debit is a plus. Customer owes less, credit is a minus. Okay, next, let's take a look at this question. They say that on 1st Jan, goods worth $5,000 were sold to Sally on credit. The goods cost $2,000. Okay, notice that there are actually two figures in this question. The first one is $5,000. Okay, the second one is $2,000. Okay, now the question is, okay, which figure to use, which number to use? So always go back to your journal entry. We know that $5,000, okay, this is actually my sales revenue. The business earns $5,000 from selling the goods. Okay, but my cost of sales is $2,000. Okay, so what is the journal entry for 1st January? It's actually debit, trade receivable, credit, sales revenue. This is 5,000, okay, the amount that they earn from selling the goods. But we also know that the goods actually cost the business $2,000. So debit, cost of sales, credit, inventory. Okay, so because in this case, we are doing the trade receivables account, okay, debit plus credit is a minus, owe more, credit owe less. So on 1st Jan, let's write the year first. I have 2015. Okay, January 1st. Okay, business actually sold goods to Sally $5,000. So Sally owes the business $5,000. Okay, she owes more. So we write down $5,000. Okay, Sally owes the business more. And the opposite account would be my sales revenue. Okay, so this will be a $5,000 debit. Then on 5th Jan, okay, the goods previously sold on credit to Sally, which was worth $500, was returned to the business. And the cost of the goods returned was $150. So you can see that in this case, there are two figures again, $500 and $150. What would the journal entry be in this case? Okay, this is actually the sales returns. Okay, and this $150 is actually the cost of sales. Okay, if you're going to do our journal entry, okay, it will be debit sales returns, credit trade receivable, debit inventory, okay, credit cost of sales. Okay, refer to your journal entry on slide 4. Therefore, on 5th Jan, okay, we will write down $500, okay, because Sally now owes the business lesser since she returned the goods. She owes lesser $500. January 5, okay, right now, sales returns. We ignore the $150, okay, because we are doing the trade receivables account. We are not doing the cost of sales account. We are not doing the inventory account. We are doing the sales returns account. The trade receivables account. So 4500. Okay, then after that, on January the 10th, Sally paid $1,000 check as partial settlement of the amount owed. So now that Sally has paid the check, okay, I'm not going to do journal entries for January 10 because it's a waste of time. Okay, I'm not going to do journal entries because the question is asking us to do ledger accounts. And since there's only one figure given, it's very easy. Sally paid $1,000 check, so she owes lesser now. Okay, 1,000. Take out minus 1,000 first. She paid by check. So cash at bank. Okay, and now from here we can see that Sally actually owes the business $3,500. Remember to bring down February 1st balance brought down with $3,500 debit. Okay, why do we need to bring down the balance instead of transferring to profit and loss? Because this account, trade receivable Sally, this is my asset. Therefore, we need to have a balance brought down. If it was a expense or income account, by now you should know that we must transfer to profit and loss. Okay, next. Okay, so difference between trade discount and cash discount. Okay, this we have gone through this in Sec 3. Okay, so please do a recap of your notes again. This is in chapter 6.